Let's talk about a bunch of things that I think will be important here for our presentation. Um, there has been a lot of changes in this week regarding the macro environment and data that came in, and mostly I would say that the data was around the inflation, and inflation was supposedly better than expected. We've had different measurements that have shown that the government data for inflation has improved, and therefore Jay Powell and central bankers would be able to not have to necessarily hike rates as some actually have proposed recently, rather than interest rate cuts and other shifts in the monetary policy that we've had recently. But this chart is a just an important reminder of how inflation tends to develop. And you can see in this chart, we're looking at commodities equal weighted index in white. In the red line, you're looking at CPI itself, which Fed's target would be at 2%. And there's no such thing as a decline in the white line. As you can see, there has been a reacceleration of commodities, and across most commodities, not just the metals. I mean, we've seen even natural gas prices have been, which we talked about this in prior presentations, of the potential of natural gas prices actually moving higher. And there has been other prices of even some agricultural commodities that have moved up. A lot of focus on cocoa, but if you look at other commodities, especially in the soft area, you will find that they have been pressured to the upside in prices, and therefore that creates this upward movement in equal weighted index that is yet to actually impact inflation in a large way. So I believe that this correlation is real. And if gold prices are making new highs the way they have been recently at 2,400 and so forth, I would suspect that also has some built on expectation for inflation rising significantly, and therefore causing the metal to move the way it has been moving. If we go to the next chart, you can see that to me, what's shocking about especially monetary policy and fiscal policy and others is the reason why we've been so dovish in terms of a narrative overall is because we lived in a world that has not faced inflationary pressures for a long time. But the last time we saw something where consumer prices were moving higher and higher really was back in the 1970s. And since then, policymakers have sort of lost their notion about how to behave when prices begin to rise. And so we're seeing things in different ways. So there's the increase in fiscal stimulus, Inflation Act types of policies where we probably would never see something along those lines back in the 1970s, where policymakers are much more aware of how fiscal spending tends to create inflation. But as you can see in this chart, what is important is it shows that money supply now, I've shown charts of monetary base increasing, but even money supply is starting to rise recently. And so those are all sorts of ways of looking at monetary dilution, which we have been big proponents of how this world of lack of discipline monetarily and fiscally speaking is where we are in today, and why we want to own hard assets for the long term. If we go to the next chart, just to put into perspective more globally, because we know that U.S. money supply has been starting to tick higher, but if you look at China as well, China is making new highs in their money supply. It's at about $41 trillion. It's double the size. This is all in U.S. terms, U.S. dollar terms. It's double the size of the U.S. money supply. So you can see that this increase of money supply, this increase of credit, or this increase of monetary dilution is happening globally. And so this is such an important narrative for investors to be focused on, because ultimately is what drives what's happening with commodities, and particularly what we think is going to happen with the miners and other natural resource related businesses and countries. Let's go to the next page. And you can see here what is the line, and people are not putting really seeing the link with all these things, with the excess of liquidity in the markets. Seeing headlines like this where the roaring kit returns, and you see the price of a company go up 100+% in 2 days, is sort of, it gives you a sense of how much we've been living in a speculative environment for a while now, and this is arguably worse than we've seen in other areas, even in the tech bubble as well. Given the fact, I think someone had a PE ratio of GameStop, although it's been declining in the last 2 days. GameStop had a PE ratio over 1,000 times, which is one of those things that you only see during speculative periods. And if you go to the next chart, what I show here is that meme stocks or GameStop and others, AMC and so forth, that were surging recently here, have a correlation with inflation expectation. Now, you may say statistically this is not relevant because it only happened once, and I totally agree with that. But we've never seen this before, where this level of speculation because of excess liquidity is also what drives inflation expectation higher. A lot of people that were back in 2008 and saw the global financial crisis in the markets, and also realized that all that money printing supposedly didn't create inflation, are seeing a very different impact or type of behavior in markets today, because monetary dilution with fiscal stimulus has indeed created a real inflationary impact, along with this commodity super cycle that we've been waiting for the last decade or so, and finally starting to see the real signs of commodities starting to move. And I didn't mean to say that we have been waiting for the last decade for commodities to turn. Luckily, this has been our thesis started not too long ago, but this has been really the one of the main inflationary pillars is the chronic underinvestments in natural resources that's been creating this also this rise in inflation. But the inflation aspect is created by many drivers, and one of them is excess liquidity, which is in line with this situation with meme stocks. So the fact that people commented on this chart saying, look, this is not statistically relevant, I don't think there's disagreements there. Is really, I don't think we've really lived through a period like this before. Even in the 1930s, before, I should say, the Great Depression, the late 1920s, gold was, or I should say the dollar was pegged to gold prices at that time. So there was a level of discipline that is certainly not the case today, given all it's happening, and the money printing, or I should say the expansion of money supply and monetary base that we're seeing, despite supposedly one of the tightest monetary policies we've seen in history, is something to be worried about. So let's go to the next chart. And you can see this expanding further. I've looked at this chart of oil because I think it's hard to believe this trend of commodities will rise without oil participating in a large way. So I've been looking at oil in many different fronts, and elections coming up, and perhaps we may even see changes in terms of even the strategic petroleum reserves becoming a strong priority for the current leadership to try to reduce oil prices. And what is interesting about this is that, as you see here in this chart, there's a link between crude inventories and actual WTI prices or oil prices. So oil prices are in white, and you can see crude inventories are in red, but they're inverted. So you can see that the higher the red line goes, it means that the crude inventory is shrinking. And it makes sense. As we see the inventory shrinking, it should pressure the price of the commodity higher. So as we can see here, even if we the potential for maybe SPR selling or strategic petroleum reserve sales in the near future, it would certainly actually drive the white line much higher. And so that gap that you're seeing, or the divergence between those two lines, to me is just an opportunity that the white line is likely to follow that red line and still also build even more this inflationary impact we're seeing in the economy. Let's go to the next chart. And so manufacturing spending, we've had actually a very similar chart in our letter regarding the construction that we're seeing, electrical construction, the revamp of of electrical grids. I think Elon Musk has been very vocal on this. What he breaks down into three parts: the demand that is coming from electrical vehicles, and then you'll have electrical heating, with places like New York now banning even gas stoves and others, and probably other states will follow a similar pattern. And the third one is artificial intelligence. That there was an interesting thing that I saw the other day, where for every search that we do on Chat GPT uses about 17 times more the energy consumption than Google. And so, a Google search. And so that puts into a perspective as well of how much more we're going to need of consumption through this artificial intelligence trend that we're seeing as well. If we go to the next chart, the way that we presented this in our letter was really looking at the construction boom that is likely to also, but we haven't seen yet the same pattern happen through the commodity space, meaning capital has been flowing into construction, but not flowing into the supply of materials. And what is it going to happen? Well, we're probably going to see a shortage of materials. So that's why we're seeing metal prices likely, not only metal prices rising recently, but likely to continue to rise, given this supply and demand mismatch. The demand coming from what I just said, construction and electricity demand, and the reshoring. If anybody reads the Wall Street Journal today, had at least 4 articles talking about the deterioration of the relations between U.S. and China. The fact that Microsoft had their employees actually leaving China, being mandated to actually leave China. I guess some of the employees could actually choose to live there. They're fine; they could live there, but they've been instructed to leave China and live in other places like Australia, South Korea, and others, Singapore. And so those issues, tariffs that we're seeing now, not only with the potential for Trump's reelection, but also even from the Biden administration, creating tariffs on Chinese products coming into the U.S. So all those policies are extremely protectionist, and they raise the inflation pressure in the economy. And so therefore the reshoring is becoming more and more relevant. And as we see that occurring, we can see even more construction. I think this red line is actually poised to go much higher in my personal view. Let's go to the next chart. And so you can see that the consumption, even from a CPI perspective, if you look at the components of the inflation, government inflation index that they use, you can also find that if you look at a 3-year annualized change for electricity prices, they've been rising drastically recently. And they also sort of appear to be very similar to what we saw back in the 70s when we had the oil embargo, the Iranian revolution. There was a commodity super cycle in the early 2000s, all the way to the mid 2000s. And so, what's happening today, it's what they call the electrification, the data centers, the AI, electric vehicles, and onshoring, and you name it. There's all sorts of things really creating the green revolution, creating this blue line to start rising. And perhaps we haven't seen anything yet. And I think this is going to become more and more an important and fundamental driver for the inflation thesis over time. Let's go to the next chart. And what is somewhat shocking, but at the same time opportunistic, is looking at this chart is we're seeing gold prices surge to levels we have never seen before. 2,400 is a price, a record price for the metal. And despite all that, we are not seeing the ETF of GLD show the same level of growth in the AUM. The assets under management remain 24% lower than the prior peak. And so just imagine if 60-40 portfolios and all these Western vehicles, investment funds that tend to find allocation towards the metal through these types of ETFs like GLD, just imagine if those folks start to actually buy the metal or buy an allocation or deploy capital into gold because of many reasons. And I've shown charts like in the prior presentation. I've had a chart of how gold is for the first time in 45 years showing a better volatility profile than U.S. Treasuries. And U.S. Treasuries have been losing value in the last 2 to 3 years to a magnitude and degree that we haven't seen since the 1970s. And if the whole thesis to buy treasuries is because the economy cannot sustain higher interest rates, then I would say that a much better way of exposing or expressing that view would be through the metal itself, is because we need some level of restoring of this financial repression at some point, because the economy is so indebted that it will allow likely hard assets to perform much better than even financial assets, especially the treasury market. And so this is very important, because who has been buying gold is in the next chart, is central banks most likely. The freezing of the Russian central bank assets has caused a surge in the gold accumulation process from most central banks. And I think that this is just the beginning. And we've had many charts showing why we think this is the beginning. And one of them has to do with looking back in history and seeing how often or during other periods when how much gold allocation did the central banks have in other periods in history. And we saw up to 75 to 80% of their balance sheets. At some points, it was even 100% during other times. But even in the 70s, it was somewhere close to 75%. And so where are we today? About 19%. So we're early stages of that accumulation. And there was some articles on Bloomberg and in Wall Street Journal making the point about, which I think is very misguided, this type of analysis, saying that central banks have lost appetite for the metal at 2,400. This is not true at all. We're seeing one of the largest buying sprees for the metal this year alone, this quarter alone, that we've seen in history. And not only that, I believe central banks have a very different mandate than a traditional portfolio manager or investor or trader. They're not looking for a 20 or 15% return. They're not looking for quick returns here. Those types of institutions tend to buy the metal with the mindset of really reestablishing their monetary system credibility. They want to buy a metal because they think this is worth multiples of today's prices. And so, this is such an important aspect. I don't think they care about buying the metal at $2,400 or even $3,000 or $5,000. I think what they care about is, have we transitioned towards a better balance sheet quality? And that's going to be the big question as we move into this next years here, as we see this volatility of foreign reserves actually increase, given the fact that inflation is here to stay. And if that's the case, then cost of capital is likely to be higher, and the pressure of owning sovereign debt is only going to increase moving forward. Let's go to the next chart. Silver is probably the word of the day. It's what's happening now. It's the something we've been waiting for a while. I've full disclosure, my wife is concerned that I've been looking at this chart for too long. I've been staring at this chart for too long. This is all a joke, but I love this chart. I think this is one of the most important things going on in the markets today. We've been on here saying that this is the cheapest metal on earth, in our opinion. And it's not to say that there are not other metals that offer great opportunities and they're not even cheaper relative to other things. It's just when you think about the thesis itself, and we know how constrained is the supply of silver and how it fits into different buckets of the macro thesis that we have, it gives me much higher conviction that this metal is so undervalued. And the main reasons for that is because we know the history of silver as a monetary metal, number one. We know the history of silver when gold gets into a gold cycle where silver tends to outperform massively. We also know that the gold to silver ratio is today at historically high levels. And then on top of it all, we also have what's happening with the green revolution with solar panels and other things that silver is actually benefiting from the demand of those new changes in the economy. And so to me, it's just hard to believe that we're going to see construction to the degree that we're seeing, that we're going to see central banks accumulating gold in the next, call it 5 to 10 years, to levels that we haven't seen since the 1970s, without causing this chart to be at much higher levels. And so this gets me really excited. I think this is the most exciting cup and handle from a technical perspective, and most exciting undervalued metal that I can find in markets today. And I think this is going to be, to me, what's the most lever way to play the silver market. I think it's probably what we are doing in terms of, acquiring a silver mine, one of the largest silver mines with, the prospect of what we have with this asset in San Cristobal at prices of silver. I think I was looking this back. I think when we were negotiating, Quinton, the price of silver is $18 or so. It actually had a plunge in prices, as you can see here. Prices went below $20. And I remember people come up to me and say, Tavi, why you keep talking about silver? Why not just wait until, prices have a confirmation and we break out? Well, the reason for it is because, nobody would sell the 7th largest silver mine in the world or any other mine in the world for, when silver prices are surging already. So you have to make those movements. Full props to Quinton for doing this, because this is, I think this is going to pay off in spades. This is one of the main assets that we own, and I think this is likely to be an incredible opportunity for our investors. And I look forward to seeing, especially with silver prices, with our expectation for where it could be in the future. Let's go to the next chart. And more importantly, is not just silver. There's other things that are very interesting. I'll touch on a chart that I had it from prior week. Maybe Quinton can even talk a little bit about zinc as an opportunity. But copper prices, when you adjust for gold itself, are trading at levels that we only seen in the 1990s. So yeah, copper prices in nominal terms have been rising significantly. But when you look at inflation adjusted, true inflation adjusted, let's look at gold. Gold is a true inflation. It hasn't gone anywhere. And so my belief is that we were also going to see this metal outperform massively, even gold. That doesn't make me bearish on gold. That just makes me even more bullish on copper. And so if we go to the next chart, because we got to build a narrative, we got to look at things from a supply and demand perspective. I gave you the demand sort of case. Well, what is the supply case? Well, in the oil space, we have Saudi Arabia, the Middle East, as places that have a very large production to oil relative to the rest of the world. In the copper space, the closest we can get to that, which is about, I believe is about 27% of the total copper production in the world today, comes from one place. It's called Chile. And if you look at the Chilean production, annual production today, it's at a 12-year low. Wow. This is such an important aspect for the metal as well. We know of the difficulty of finding economic deposits in the copper space, high grade economic deposits in the copper space to really increase supply in the near term. And we also know the difficulties of putting something into production so quickly. And so this is also another important chart that really shows the relevance of how this metal is also constrained on the supply side too. Let's go to the next chart. And so, talking about what is hated in the markets, we've seen copper mines starting to show some improvements in terms of the prices of the share prices of those companies. And, that's the red line that you're looking at. And, there's this new thought about people that they always have this view that things are different this time. There's always something new that investors get hung up on with a very short history memory in terms of what's been happening here in the last few decades. And what is remarkable is seeing the metal prices actually surge and people thinking that the miners are not going to benefit from that. I mean, who in the right? I mean, I just don't understand those types of analysis that we're hearing nowadays. And when I see this, it's such an important aspect. Copper mines or miners have already started to move in a very significant way. And to think that gold miners are not going to move, to me, it just seems ludicrous. I do think that we're about to see some of the best margins that we've seen in the history of this industry. And let me tell you one thing, the miners are hungry. They are hungry for more and more ore, because there have been, especially in the gold space, been depleting their reserves for a long time. I showed a chart prior week as well showing that one fourth of the existing reserves in the gold space are actually refractory, which means they're extremely hard to be produced. And so they're hungry for new discoveries. This is where we've been investing and deploying our capital in new discoveries that we actually, some of Kevin was referring to, we actually have already found some incredible discoveries in our portfolio today. And I think that those hungry, larger miners that are making money are seeing the price of their shares increasing is going to trigger one of the largest M&A waves that we've seen in the history of this industry. So let's go to the next chart. And so there you go. And so the time to be bearish in the mining space relative to gold was maybe 2 to 3 decades ago. We're actually at the very bottom of this, most likely. And if you look at this chart right here, we've been in a downward trend for so long. And guess what? We're very close to a major breakout where we see not only gold really moving, but the miners actually really starting to lead the way to the upside and really attract capital from investors. I think this is about to happen here. And this is why I'm paying so close attention to this chart specifically. Let's go to the next chart because it's even more interesting. If you think that the miners will outperform gold, imagine the juniors outperforming the seniors, which we haven't seen yet. And that's a domino effect. And guess what? We're already today, don't tell anybody, but today we're seeing a breakout in the juniors versus seniors. So maybe I spilled the beans here, but you can see here that I think this chart is only getting started. I think we're going to see a lot more of this in the near, call it in the next 5 to 10 years. It's going to be a lot of ups and downs, and a lot of people say, well, the juniors are probably going to have to raise money. They always going to have to raise money, even if they have to dilute 5 to 10%. No, the movements that we tend to see in this industry are much more, aggressive than we tend to see even in the seniors side. And so, I think there's a reason why most of the billionaires in this industry made their money in discoveries and made their money in a junior space. And so this is sort of what we've been trying to accomplish with our own strategies here at Crescat. Let's go to the next chart. And so finally, just from a macro level, the idea of buying a small cap and a micro cap name relative to a large cap name is interesting from many fronts, not just from a mining perspective, but even if you look at the overall market. If you look at overall markets, the valuation of a small cap company versus a large cap company has never been so dislocated since the 1970s or the early 2000s. Now, I can maybe propose here a view that is different than the 1970s and the early 2000s when it comes to the global economy and so forth. Now, the natural resources space actually looks remarkably similar. And majority of the small cap companies that are in this index are actually, a lot of them have resource related businesses. And so I do believe that what we're about to see is that small companies are going to also outperform large cap companies, not only in the mining space, but the overall space of the market in a big way in the near future here as well. Finally, I think I have one more chart or two more charts. One of them is the opportunity ahead. I mean, just looking at what we've seen in the past in terms of the size of the gold market and the size of the gold market today, and the potential for flows coming out of other asset classes and coming back into the gold space. This is what the chart speaks about. It basically shows you that if you look at the gold and the gold miners relative to global assets, including real estate, bond market, equity markets, we are at one of the lowest levels in terms of a weight of an industry as a whole we've seen in history. Now, where can we get from here? Well, prior times, I'm not joking. As you can see in this chart, it was 20 times higher than what it is today. Can we get there? No, it's just an opinion. I do think that there's a potential, even if I'm wrong about going 20 times, and even if it is 5 or 3 times, I'll be happy with that. And I do think there's a potential for that, just given the fact of how much capital has been dislocated for so long and industries that get neglected for so long. And even from a professional perspective, the fact that we haven't seen geologists entering the industry and so forth. And this is the main reason why I think this industry will perform so well in this next decade here. Now, finally, this is my next chart. Just a final point, because if you have that view, let's jump this one because it's the same point. But the next, there we go. that final view is that if you have that opinion about the dislocated portions of the market, another portion of the market has also been ignored from a capital allocation standpoint, is also the emerging markets, the rich resource economies that we know of. And one of them is Brazil. As you can see here, you're looking at two lines. One of them is the price of the equity market, and the blue line, you're looking at the actual fundamentals of those companies. And you can see a big divergence between the two, which means that those companies just got a lot cheaper. Not only because prices have gone sideways, but because also their fundamentals have been surging recently. And where do I think we go from here? Well, if I'm right about commodities and the cycle for commodities overall, particularly in the mining industry, where the Brazilian market is so heavily weighted in energy and mining, I would think that the white line is going to follow those fundamentals at some point. And so we've been very bullish in emerging markets, emerging market currencies, and Canadian currency relative to the US dollar, and obviously the mining industry itself.